Hey everyone, so this video is about the book One Up Wall Street by Peter Lynch. And for those of you who don't know who Peter Lynch is, he is one of the greatest investors of all time. He was a fund manager at Fidelity and he managed a fund called the Magellan Fund. And during his time as a manager or fund manager of Magellan, he was able to get annual returns of 29%. Now, to put that into perspective, the S&P 500, which is basically America's stock market, or it's the composite or the index of America's 500 biggest companies, and the S&P 500 only got an annual return of between 8 to 10% a year. Obviously, every year is different, but overall, between 8 and 10% on a per year basis. And he was able to get 29%. So that's a 20% gap between the S&P 500 and what he was doing. And so pretty much what he talks about in terms of investing and how to pick companies that are winners, I think he knows a thing or two about them. And so this book is such a great book for those of you who are interested in learning to invest or want to increase your investing knowledge. Definitely check out this book. It has a lot of great principles that I've read from other investors such as Benjamin Graham's Intelligent Investor and Warren Buffett's style of investing. So this book, it talks about his decisions or decision-making process or some of the things that he looks out for when he invests in a company or when he buys stocks. All right, and so in this video, I'm actually going to share with you some of the points that he addresses in his summary. So in the book, there's a summary of all the points that he lists out, and I'm going to share with you some of those points. And they're all really great points, but the ones that I'm going to share with you, I think are the kind of most important ones. Obviously, everything that he talks about is the most important, but just for the sake of this video, I'm going to share the ones that I thought were the biggest ones. Okay, so let's get started. Now, the very first one, understand the nature of the companies you own and the specific reasons for holding the stock. Consider the size of a company if you expect it to profit from a specific product. Be suspicious of companies with growth rates of 50 to 100% a year. Avoid hot stocks in hot industries. Long shots almost never pay off. Invest in simple companies that appear dull, mundane, out of favor, and haven't caught the fancy of Wall Street. Look for companies with niches. Companies that have no debt can't go bankrupt. Managerial ability may be important, but it's quite difficult to assess. Base your purchases on the company's prospects, not on the president's resume or speaking ability. Carefully consider the price earnings ratio. If the stock is grossly overpriced, even if everything else goes right, you won't make any money. Look for companies that consistently buy back their own shares. Study the dividend record of a company over the past years and also how its earnings have fared in past recessions. Devote at least an hour a week to investment research. Adding up your dividends and figuring out your gains and losses doesn't count. Be patient. Watched stock never boils. And the last one, invest at least as much time and effort in choosing a new stock as you would in choosing a new refrigerator. So there you have it. Those are his points, or the top points from his top points or his summary. And one thing I would like to add about this, when I was reading this book, something that I just kind of realized was that if you want to become good at trading or buying and selling, you have to be, well, number one is you can't think so much with emotions. People are very emotionally charged when it comes to stocks. You know, you hear a hot tip, oh, I'm gonna buy that, but you know nothing about it, right? So that's what Benjamin Graham talks about in The Intelligent Investor, separating emotions with money. And that's what's really difficult. When you see your money going down, your emotions come to play, and then that's why you have people who lose money. And so in the book, The Intelligent Investor, Benjamin Graham was saying to become an intelligent investor, you don't necessarily need to be smart. You just need to be good with separating your emotions with logic. So if you know that something's going up or will go up, but the price is going down, being able to hold on to that share or those stocks, that's what makes you intelligent compared to the people who are very emotion driven. So that's one thing. The second thing that I kind of realized from reading this book is that if you want to be good at anything, you have to put in the time, energy, and effort to study something, to learn about it. And this kind of goes back with the 10,000 hour rule that Malcolm Gladwell talks about in his book called Outliers. And in that book he says that, you know, anyone who's of greatness or anyone who's done a lot of things in life, anything significant, they've all spent at least 10,000 hours, and through the 10,000 hours they've gained a level of mastery. And so that's the same thing with yourself. If you want to make money, you got to spend the time to learn about investing, or learn about how companies operate, or learn about what their numbers mean on their financial statements. And so yeah, those are two things that I think are very key: separating emotions from logic, and knowing or spending the time into learning about investing. All right, well, anyways, I hope you enjoyed this video. If you did, please give it a thumbs up. Hit that subscribe button if you want further notifications of future videos or future videos of books that I've reviewed. And yeah, if you're interested in the book, there's a link down below. And check out my website at www.bookstakeaway.com to see other videos or other books I've reviewed. And yeah, thank you for watching, and I'll see you again in the next video. Bye for now.